IWF's 100% return crushed CGGR's 81%. That's a $165,000 difference on your 100 grand investment. IWF's lead widens as time goes on. Notice that massive 19 percentage point gap over 5 years. Over 3 years, IWF's 95% return edges out CGGR's 93%. A tight race with IWF still ahead. Over the past year, both funds tied at 17% returns, so short-term performance doesn't separate them yet. Think of it like a race car finish. IWF crossed the 5-year line a full lap ahead. Same track, just a better engine under the hood. Here's what's surprising. Identical Sharpe ratios mean both funds delivered equal risk-adjusted performance over 5 years. IWF's slightly better at protecting downside. 1.5 versus 1.4 means marginally smoother rides when markets drop. Think of these ratios like mechanical leverage, how much return you're getting per unit of risk taken. Same efficiency, different paths to get there. CGGR held up better when markets tanked, limiting losses to 29% versus IWF's 33% crash. CGGR bounced back 40 days faster, proving it's more resilient when the market takes a beating. IWF's worst year crushed investors with a 38% loss, while CGGR's 16% drop was far more manageable. IWF plunged 33% at its worst. CGGR dropped 29%. Both funds hit rough patches, but IWF's roller coaster had a slightly steeper drop. That IWF's lower fee gives you a 0.21% annual advantage. That difference compounds into serious savings over decades. 18 cents versus 39 cents per $100 seems tiny now, but that couch change compounds into thousands over 3 decades. You're invested. CGGR spreads risk globally with 8% non-US exposure, while IWF stays almost entirely domestic at 0.27%. CGGR spreads your eggs across global markets, while IWF keeps nearly everything stateside. It's the classic diversification play, domestic focus versus international spread. So IWF's 391 holdings spread your bets wide, while CGGR's 105 stocks make bigger, bolder, concentrated plays. IWF wins on returns and costs, delivering 100% gains at half the expense. CGGR counters with better crash protection, losing only 29% when markets tanked hardest. CGGR is holding just 105 stocks versus IWF's 391 means concentrated risk. One bad pick hurts 4 times harder here. IWF's spread across 391 holdings cushions falls better. CGGR's 105 blocks, each crack hurts more. It's like building stability versus concentrated bets. CGGR's trading at a discount here, 23.3 versus IWF's premium 28.3. That's a meaningful valuation gap worth noting. CGGR's lower valuation at 23.3 gives you more margin for safety versus IWF's premium 28.3. Think of PE ratios like marathon pacing. CGGR runs at $23 per earnings mile. IWF at 28. Same race strategy, different energy costs per mile. IWF doubled your money while CGGR fell short. Same risk, 19 percentage points more wealth. That's pure dominance. CGGR's downside protection shines through. Shallower crashes, smaller losses, and faster recoveries when markets turn ugly. So there you have it, IWF for maximum growth, CGGR if you'd rather sleep better during market crashes. Think of it like race cars. IWF sprints hard with bigger crashes for faster times, while CGGR paces steadily with fewer crashes but slower finishes. You're responsible for your own money. Do your homework and talk to professionals first. If you found this helpful, hit subscribe for weekly comparisons and drop your battle requests in the comments.